Hi there. Are you missing vital UK tax offsets, like the tax relief when your investments lose money? Today we will explain how to claim UK tax relief before it's lost.
Losing money on an investment could actually save you thousands in taxes. Sounds a bit mad, doesn't it? But in the UK's current tax climate, it's absolutely true. Today, with some brilliant insights from the expert tax advisors at My Tax Accountant, we're going to show you exactly how to turn your investment losses into a powerful tax-saving tool.
Let's kick things off with a number that should really make every UK investor pay attention. £3,000. As of 2026, that's it. That's your entire tax-free allowance for capital gains for the whole year. It's shockingly low, and it means a lot more of your profits are now on HMRC's radar.
So with that tiny £3,000 allowance, the big question is, what happens when your investments go the other way? It's something we'd all rather not think about, but in this new tax landscape, understanding your losses is just as critical as celebrating your gains. In fact, it might just be the key to protecting your wealth.
Right, first things first, let's get our heads around the new landscape. It's something the experts are calling the new tax squeeze. I mean, just look at how sharply the tax-free allowance has been slashed. A few years ago, you could make over £12,000 in profit before paying a penny of tax. Now, that buffer is down to a mere $3,000. This means every single pound of your investment returns is under the taxman's microscope.
And as if that wasn't enough, the tax rates themselves changed partway through the 2024 to 25 tax year. This means the timing of when you sell your investments now has a direct impact on the tax rate you'll pay. Selling in September could give you a very different result to selling in November.
Okay, so how do you actually turn a loss into a tax-saving opportunity? Well, it's not as simple as just selling something for less than you paid. There's a crucial step that so many people miss, and believe me, it can be a really costly mistake.
You see, an investment loss only becomes useful when it's formally recognized by HMRC as an allowable loss, and this is not automatic. An investment can drop to zero, but if you don't do anything, that loss is invisible to the taxman and completely useless to you.
The good news is that making it official is a pretty straightforward three-step process. First, the asset is sold. Second, you calculate the loss. And third, this is the golden ticket. You report it to HMRC on your tax return. It's that simple. But don't underestimate step 3. It's the one people forget, and it's the one that unlocks the tax savings.
And you're on the clock. You have to report a loss within 4 years from the end of the tax year it happened in. So for a loss in the 2024-25 tax year, you've got until April 2029 to claim it. Miss that window, and poof, the loss is gone, for good.
Now here's a brilliant tip straight from the advisors at My Tax Accountant. Report every single loss, no matter how small. Why? Because you can carry that allowable loss forward, indefinitely, to use against future gains. Think of it like banking a tax deduction. You're saving it for a rainy day.
Right, now for something that catches an unbelievable number of people out. It's a real hidden tax trap, specifically designed to stop investors from trying to be a little too clever with the system.
This rule is all about stopping something called bed and breakfasting. That's the old trick of selling shares to create a tax loss on paper, only to buy them straight back the next day. You keep your investment, but you've manufactured a loss to use against your tax bill. Well, HMRC is wise to this.
So, how do they stop it? Well, they have a very strict pecking order for matching your sales with your purchases. First, they look at anything you buy on the same day. But crucially, and this is the bit that catches everyone, they then match your sale against any shares you buy in the next 30 days. That little window is the trap.
Let's make this real. Meet Sarah. She sells some shares and thinks she's cleverly created a £2,000 loss to use. But then she makes a critical error. She buys the same shares back just a week later. Thanks to that 30-day rule, HMRC steps in, and her useful loss shrinks all the way down to just £500, a really painful and avoidable mistake.
And look, don't think for a second this is just for hardcore day traders. Oh no, this can trip up anyone. If you use a robo-advisor that automatically reinvests for you, it could trigger this rule. It even applies if your spouse or civil partner buys the same shares back within that window. It's a rule that follows you, not just your account.
So we've covered investments that have gone down in value. But what happens when an investment completely craters and goes to zero? And how on earth do these rules work in the frankly wild world of crypto? Let's find out.
This is a situation some of you have probably faced, unfortunately. You own shares in a company, maybe a promising startup, and it fails. The shares are worthless. You can't sell them. So what do? How do you claim that loss?
The answer is something called a negligible value claim. This is where you formally tell HMRC your asset is now worth next to nothing. This creates a deemed disposal. It's like you sold it for zero, which crystallizes the loss. But here's the really brilliant bit. You can choose to apply that loss to the current tax year, or you can backdate it to one of the 2 previous tax years. That's incredibly flexible.
Now, for all you crypto investors out there, listen up, because the rules are very, very specific. If you lose your private keys and can prove they're gone forever, you might be able to make a claim. But, and this is crucial, if your crypto is stolen, you're out of luck. HMRC sees it as theft, not a disposal, so you cannot claim a capital loss for it. That one is a brutal rule and catches many people out.
Okay, stay with me, because this next point is a real game changer, especially for small business owners and startup investors. You'll want to hear this part. It's one of the most powerful but lesser-known reliefs that HMRC offers. It's called share loss relief. For certain types of shares, we're typically talking about unlisted private trading companies that you invested in from the start. You can set the loss against your income, not your capital gains, your income, your salary or trading profits. This is huge because you get tax relief at your income tax rate, which could be 40% or even 45% instead of the lower capital gains rates.
Right, let's pull all that together. The must-knows are, manage your investments with that tiny 3,000-pound limit in mind, always report your losses within 4 years, watch out for that 30-day trap, don't get caught, use those negligible value claims for failed investments, and finally, always check if your share losses could qualify for that powerful relief against your income.
Okay, before we finish up, a really important point. We've covered a lot today, but this is all for general guidance. Tax is frankly a minefield, and everyone's situation is unique. So please, don't use this as a substitute for getting proper professional advice.
If you want to make absolutely sure you're taking full advantage of every tax-saving opportunity, we really do recommend speaking with an expert. The team at My Tax Accountant who helped put this all together are fantastic. You can find their contact details on the screen now. Thanks so much for watching, and don't forget to subscribe for more clear, practical tax tips.